Today on the program, Africa Continental Free Trade Deal to push ahead even if another virus wave hits. IMF and Sudan agree on policies for a staff-monitored program. And Kenya MPs approve new taxes to boost revenue during pandemic. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. First, the markets. And the Nigerian stock market index saw slight recovery at intraday after days of bearish trading. The all-share index was marginally up 0.01%. The South African JSE index, on the other hand, was down 1.04% as markets await Finance Minister's emergency budget presentation. In Egypt, the index traded in the green, up 2.49%, outperforming others, while Kenya closed in the negative on Tuesday, almost 3% down. In the Middle East, most of the markets were in the red at intraday except Abu Dhabi. The Abu Dhabi index was up 0.24%. Dubai dropped 1.01%. In Qatar, the index was down 0.38%, and Saudi Arabia was also down 0.44%. And in Europe, stocks opened lower today as a surge in coronavirus cases in the US and beyond, and regional outbreaks in Germany spooked investors. Well, let's bring in Chelsea now for more. Hello, Chelsea. Good afternoon. Well, Germany has locked down 2 districts in Western Germany amid a surge in coronavirus cases linked to a meat processing facility. But is the outbreak under control?
Officials here in Germany are trying to ease concerns about this outbreak, but it still is obviously a big warning sign for people here in Germany and throughout Europe. This is the first time that Germany has had to reimpose lockdown measures since it began lifting those measures over the past couple of weeks. This new lockdown it's being imposed on, as you mentioned, 2 districts in Western Germany that encompasses about 600,000 people. And so far, health officials here in Germany have said that this outbreak is quite localized, that it's stemming almost entirely from this meat processing facility where around 1,500 workers were found to be infected with the virus. But this also comes amid just a big resurgence in coronavirus cases around the world. In the United States, they've seen the largest number of new infections in 2 months. We've seen new hotspots again in places like Korea, Japan. So this is certainly creating a lot of fear. And as we've seen throughout the entire course of this virus, hotspots and what seem to be isolated outbreaks do quickly spread around the world. So in places like Wuhan or Lombardy in Italy, that was seen to be a contained outbreak that was very quickly allowed to spread because of a lack of restrictions on travel and things like that. So there's definitely a fear that these what seem to be isolated outbreaks at this point could continue to spread throughout Europe and the world again.
And the European Union may not allow U.S. citizens to travel to the bloc when it lifts external border controls on July 1. What has the reaction been from businesses there?
For businesses and for the broader European economy, this would be a bit of a blow, especially for the tourism industry. American travelers are a huge source of revenue for tourism and for travel here in Europe. Millions of Americans come every summer to go to places like Italy and Portugal, and those economies are quite dependent on those travelers. So if Americans are not allowed to come for the summer, then that would certainly add more pressure onto these companies that have already really been reeling from coronavirus shutdowns. What EU officials have said is that they haven't quite made a decision yet. They're expected to formally decide next week, before the July 1st reopening here in Europe. But they say that with just the stage of the outbreak in the United States, it wouldn't make sense for them to be allowing European or American travelers in at this point. But they will continue to reevaluate every 2 weeks whether they will be able to lift the lockdown or allow the borders open for American travelers. So even if they aren't included in this first wave of visitors being allowed in, they could be in the future.
And in corporate news, French drug maker Sanofi says it is accelerating development of its potential coronavirus vaccine after lagging behind competitors in the race for a treatment. What is the outlook for a potential vaccine now?
There are a lot of companies that are trying to be the first to market with the coronavirus vaccine. At this point, I think there are something about 150 vaccines in development by basically all of the major players in the pharmaceutical industry, and many smaller biopharmaceutical firms also are really just trying to get to develop a vaccine very quickly, because as we know, the world economy will not go back to normal until a vaccine is found, and we will continue to have fear about second waves of infections, third waves of infections. So it really is very crucial, both from a public health and a business standpoint, to find a vaccine. But we do what most pharmaceutical makers are expecting right now is they do expect to get a vaccine to market somewhere around next year. All of these pharmaceutical makers are at different stages of development, but they do expect to get their regulatory approvals maybe in the beginning of next year to get a vaccine out in the middle of next year. So still a long timeline, but there is definitely hope on the horizon.
Well, let's just hope they find a vaccine soonest. Thank you very much, Chelsea. And the market fall was not just in Europe. In the UK, the FTSE 100 was down 1.8% in the morning, and that more than wiped out yesterday's gains and knocked shares to their lowest levels in nearly a week. But has that changed at intraday? Let's find out from Juliana. Hello, Juliana. Good afternoon. While concerns about a second wave in COVID-19 cases seems to be roiling the market, how are the London markets doing at intraday?
Good afternoon, Chima. Yes, that scare about the second wave, that has been dominating market sentiment for a couple of weeks now. Yesterday, as you said, there were some gains, and that was because we had some pretty healthy PMI data showing that the economy could indeed bounce back in the third quarter. But it's not the case at early trading. And then again, there have been some reports, which is a big breaking story, actually, that the US is contemplating putting $3.1 billion worth of tariffs against the EU exports. And when I say EU, they've also lobbed the UK in that. So that involves exports coming in from UK, France, Germany and Spain. There's a tit for tat going on at the moment because, of course, we know that the US Trade Department are not happy at all with this digital trade tax, which the UK and other countries are trying to impose on big tech companies. So that really is what's dominated this major fall. The FTSE All-Share at intraday is down 2.15%. The FTSE 100 is down 2.21%, and the FTSE 250 is down by 1.70%. In currencies, the pound is unchanged against the US dollar. It's up against the euro by 0.09% and up against the Japanese yen by 0.06%.
And talking about the pounds, currency analyst at Bank of America believes the pound is fast becoming an emerging market currency. Could investors be losing their trust in the sterling?
Well, I believe so. And these are pretty biting words from the Bank of America. It'd be interesting to see just how Britain respond. And I do expect there to be quite a sharp response because, of course, the sterling is heralded as one of those big G5 currencies. But this is in relation to Brexit. You know, before pandemic, there was Brexit. And earlier this week, it was actually the 4th anniversary since that June 2016 referendum. Of course, it wasn't marked here in the UK because I presume the government would rather put that behind them. But analysts did pick up on that. And there was one, Carmel Sharma, who is a currency analyst at Bank of America. It's worth reading out a part of his statement to me. He said, in relation to the 4th anniversary, that we believe sterling is in the process of evolving into a currency that resembles the underlying reality of the British economy. Small and shrinking with a growing dual deficit problem similar to more liquid, which is emerging market currency. So he didn't mince his words. And really what he was relating to is the fact that at the moment, investors and traders just can't put their finger on whether or not the sterling is going to be going up and going to be going down. Since the referendum in 2016, it's already lost a fifth of its value. So he doesn't believe, and there are many who would agree with him, that it can be compared to the Japanese yen or the euro or the US dollar. But, you know, it is still a sterling, it is still a G5 currency. But like I said, it would be interesting to see just how British economists respond to those cutting remarks.
Absolutely. We would like to know that. Anyway, it is a critical day today for the UK's commercial landlords as they attempt to collect about £2.5 billion in rent from their struggling tenants, including retailers, restaurants, and pubs. Now, how is that playing out?
Well, we don't know at the moment. Today is due, it's due today, and it's not the end of the day yet. But it's going to be difficult because I'm sure many of our viewers must know when the rent is due and there's no money in the bank, there's nothing that you can do. We know that retailers have had their doors shut for a good 3 months, and even before the global pandemic, retailers were struggling. They were struggling with competing with their online competitors. They were struggling with high business rates. Many business lobby groups have been writing to the government asking for those rates to be reduced, and they were also complaining that a lot of their part-time employees were having wage rises. So it's been a difficult situation with them even before the pandemic. Then that took hold, and the government, of course, gave so many rent holidays, asked a lot of landlords to just cool down in trying to get this money back. But the 3 months are up, so they are going to be knocking on doors. Apparently, £2.5 billion is owed to landlords, and there are concerns. We know that many retailers haven't yet opened, even though they were given the green light last week, Monday. Many of them won't be because they've gone under, and many of them are still struggling to try and recoup some of their lost earnings. And we do know, because I believe I did discuss it on channels a couple of days ago, that one of the big landlords for shopping centres they're actually speaking to administrators at the moment, KPMG, and they're hoping on Friday they can get a loan to increase their tenancy, but it's not looking likely. So not only are the retailers in trouble, it's the landlords that are also in heavily debt.
It's absolutely not going to be easy for the landlords. Anyway, thank you very much, Juliana. Enjoy the rest of the day. And stocks in Asia Pacific mostly edged higher today as Hong Kong listed shares of Chinese tech juggernaut slipped from record highs seen earlier in the day. In South Korea, the Kospi rose 1.42%. Over in Hong Kong, the Hang Seng Index closed 0.5% lower. Mainland Chinese stocks were higher by their market close, with the Shanghai Composite up 0.3%. The Shenzhen Component gained 0.165%. In Japan, the Nikkei 225 was fractionally lower on the day, while the Topix Index shed 0.42%. Australia's S&P ASX 200 added 0.19%. Overall, the MSCI Asia ex-Japan Index gained 0.1%. And futures contracts tied to the major U.S. stock indices pointed to a slightly lower open following a largely positive day on Wall Street in the previous session. Now, Dow Jones Industrial Average futures dipped 251 points, suggesting an opening loss of about 255 points when regular trading resumes today. S&P 500 and Nasdaq 100 futures also pointed to a slightly lower start for the two indices. On Tuesday, the Dow closed 131.14 points higher as Apple, United Health, and Visa led the blue chip index higher. The S&P 500 gained 0.4% to end the day at 3,131 points. And oil futures dropped in early trade, extending losses from the previous day after U.S. crude stockpiles grew more than expected, adding to worries about oversupply. Brent crude was down 29 cents at $42.34 a barrel, while U.S. West Texas Intermediate crude futures fell 35 cents to $40.02 a barrel. And still to come on the program, AFCTA to go on even if a second wave of coronavirus infections hits the region. This and more in a moment. And ahead of South African Finance Minister's emergency budget presentation today, traders seem unfazed by much ado about nothing budget. But let's see what economists there think. I'm being joined by Trinity Nkube, an economic analyst there in South Africa. Good afternoon, Trinity. Thank you very much for joining us on the program.
Thank you for having me. Good afternoon.
Now, traders bracing for Tito Mbowene's emergency budget have a message for him, and they say, tell us something we don't already know. The budget deficit is expected to widen. As an economic analyst, what are you expecting from this budget today, looking at the state of the economy?
As you rightly put it, it's more of the same. We are living in very special circumstances, so we expect the finance minister to have some prioritization regarding the 500 billion or so rands that has to be dispersed across the working population as well as the unemployed. It's a very tough economic environment to navigate. However, we expect him to do the right thing. And if I may, I'm a big supporter of Tito Mboweni. He has been clamoring for reforms all along, and he has met a lot of resistance, from the political front. At this point, it's an idea of reform or perish.
Now, the Statistics Office released a record high unemployment data yesterday, highlighting weakness in the economy even before it was battered by COVID-19 pandemic. How did you see that data, and do you see this emergency budget factoring in this worrisome data?
As I just alluded to in my previous response, there is definitely a lot of labor bargaining, and COSATU is very much at play when it comes to these decisions. So Tito Mboweni has to factor in the issues of labor. And if I may, before the COVID pandemic, we already had issues. We already had an economic recession. You had all the downgrades and so forth coming in. So as we look at it, almost a third of South Africans are unemployed. We're looking at almost 7 million jobs being lost. Hence, the structural issues beyond what the finance minister can do. Hence, he's been clamoring for reforms. And I think the unions also have to come to the party. People shouldn't just throw in questions. When you throw in a question, you should have an answer for it. And ideally, the finance minister and the president have a very difficult job at their hands.
And then some of the country's big firms, such as steel producer ArcelorMittal, food producer Tiger Brands, and third biggest telecom operator Cell C, already announcing plans to cut jobs. What does that tell you about the outlook for the labor market?
We're in for a tough time. When you look at it, as I said, 7 million jobs. Each of these big firms that you've just mentioned is cutting at least 2,000 jobs or more. And we're looking at this happening, in the short to medium term. Now, this is something that I've been saying all along for the past 18 to 24 months, that South Africa needs to invest in its people. And if we are at this point where when people lose their jobs and don't have a second or third income, we're in really big trouble, where now the government has to take a paternalistic stance in which they have to bail out everybody. Imagine if they had to bail out half of the people that they have to bail out now, their job would have been much easier. So job losses are a reality. That was always coming, with or without the pandemic, if I may say.
Now, we'd already battered the economy, and now, of course, COVID-19. Are there other options left for President Ramaphosa and his team to rescue Africa's most industrialized economy? We've seen the battle with the government firms like the South African Airways and so on.
Reform or perish. This is something that has been said over and over again. At this point, we don't even have a choice. At least right now, almost every economy is in trouble. So this is also a big opportunity to rebuild. So we can't even talk about rescue. Right now, it's rebuilding because so much is going to be lost, but not everything is lost. If we can invest in the youth, there's a lot of rhetoric around politicians to say, let's invest in the youth. But I do not see, when we coach young entrepreneurs and so forth, we would like to see a little bit of seriousness and genuineness when it comes to investing in the youth. We need small to medium businesses so we can create our own jobs without relying too much on foreign direct investment. And if you look at all the measures that are being taken right now, yes, there's some really good and positive signs in terms of they're trying to resuscitate the economy, but we need to learn from the past. We need to invest in our people. One of our human capital is well invested in, and the seriousness on both the supply and the demand side will actually have a better functioning economy structurally. And I think the structural issues are the ones that we're dealing with.
Human capital investment, that's a major takeaway from what you've just said. Thank you very much, Trinity, for your time.
Thank you very much. Thank you for having me.
An African-wide free trade agreement is unlikely to face any further delays, even if a second wave of coronavirus infections hits the region. That's according to Secretary General of the African Continental Free Trade Area Secretariat, Wamkele Mene. Speaking at the Bloomberg Invest Global Virtual Conference, Mr. Mene says if the pandemic continues into 2021, the continent will develop the necessary public health protocols to continue and to push on with the implementation of the African Continental Free Trade Area. He maintains that the Secretariat will take advice from health officials as it works to implement the deal and revive economic growth on the continent. While the agreement entered into force legally last year, commerce due to have started on July 1 has been delayed as the pandemic set back negotiations to lay the foundation for trade in goods, including tariff concessions. And the International Monetary Fund and Sudan have reached a preliminary agreement on policies for a staff-monitored program, a step the North African country sees as crucial to overhauling its battered economy. The one-year program aims to narrow macroeconomic imbalances and strengthen governance and social safety nets while making progress towards eventual debt relief. The agreement is subject to approval by the IMF's Management and Executive Board. And Kenya's National Assembly has approved a raft of tax measures, including a charge on all companies as the government seeks to boost revenue and navigate the coronavirus fallout. Lawmakers approved the Finance Bill 2020, which includes a minimum tax of 1% on gross turnover. The measure could raise about 21 billion shillings yearly. It will also ensure companies that perennially report losses also contribute to government programs. Kenya is looking to raise money to fund its 2.8 trillion shilling budget for the next fiscal year and help boost an economy battered by the virus. The government wants to narrow its budget gap to 7.5% of gross domestic product in the year starting July. The lawmakers also approved a 1.5% digital levy targeted at non-resident companies that derive income from Kenya, including taxi hailing platforms and streaming sites. And that's a wrap on the program. Thank you for watching. I'm Chimezie Obi Iwago.